This is Ken Long from Tortoise Capital with a review of the weekend trading reports for May 18th, 2013. Greetings from Raleigh. We've got a market that is bullish normal. On an annual basis, using weekly RSI 14, it is 77 out of 100, which is considerably overbought. It can stay overbought for long periods of time. On a 10-day index, we're at 107. Which is overbought and represents a 7% breakout from the previous 10-day trading range. Looking at additional indicators on the market mosaic, price relative to the 200-day moving average is stretched to 13.58%, which is coded green bullish, meaning exceptionally strong move compared to the last 6 months. The slope of the 50-day moving average has improved to 0.79%, which is coded white bullish. That's strong, but not as strong as it has been in the last 6 months, but still very bullish. ADX 14 is at a strong 32.0, up from 27 last week, so we have a strongly trending up market. ATR percentage is declining to 0.80% at the low end of normal. The VIX risk index is at 1.06, favoring the risk on trade. That's the 30-period moving average of the VIX divided by the 10. That score of 1.06 creates a z-score of 0.73 when compared to the last 5,000 trading days. The histogram below shows that we are approaching the upper bounds of normal at 0.73. This is a time to ensure that your profit preservation stops are in place and that you are prepared for an intermediate market state change. The blended monthly rebalancing portfolio continues to hold Japan, U.S. real estate, and Australia in both the 26 and the 13 ETF portfolio, with the next reevaluation being due on or about 1 June. The weekly ETF2 theoretical exposure is at 90%, with 9 out of the 10 major market indices on a buy position and only 1 on cash. The model portfolio itself will be at 100% exposed. We're updating 8 of the stops, which made new highs this week. Examples for trades of the week and other movies of interest will be at the YouTube channel you see noted below. Taking a quick look at the 13 and the 26 ETF portfolio. Current readings in the 13 ETF, the top 3 are Japan, U.S. real estate, and U.S. large caps, with only Australia, Treasuries, and Latin America on a cash position, which is triggered by price going below the 4-month moving average. On the 26 ETF portfolio, the top 3 holdings are Japan, U.S. finance, U.S. real estate. The cash positions are dominated by global and emerging market symbols along with selected commodities. Taking a look at the market health check. Vertical blue lines are 10, 20, and 30 days of look back. The horizontal purple line is at the swing high at 166, which was exceeded on Friday for a new breakout to a new high. The horizontal red lines are support levels that used to be resistance levels and represent downside targets if the market reverses here. The black center line is the RAF regression channel 30 days, which lags 1 day, with the outer channel being formed by the outer black lines, which created by the maximum excursion from the regression line during the look-back period. As you can see, price is at the outer edge of the floodplain, so we're at an extended bullish move. The slope of that 30-day regression line is as strong as it has been in the last 6 months, so again, we're at the end rather than close to the beginning of this leg up, and you can see that we have 1, 2, and then 3 legs up, which puts us at in a strong position in the market. Looking at Williams percent R, the market's been overbought for 20 days, and it can stay overbought for an extended period of time. ADX, you can see, has moved from below 15 to above 30 in the last 2 weeks, indicating a strengthening bull move. Looking at percent price oscillator, The jaws remain open, so there's still room for another 5 to 8% move to the upside, which would take us above 170 and would still be within the bounds of normal. So we have a beginning to rage bull here that's still within the bounds of normal in terms of upward extension. However, there are some signs that indicate make sure that you're tightening up your stops. The next support level to the downside is at 163, and then significant support at 160 in case we get a market pullback here. Looking at the ETF2 regional report, the 10 indexes in the market model, 9 of the 10 are on a buy position, which puts us at 90% invested in the theoretical model, 10% in cash. The S&P is doing better than the globals, with the S&P at 38 and EFA being at 36. So right now the U.S. is favored over the globals. Inside the U.S., the order is mid caps, large caps, small caps, then technology. The two strongest sectors are Japan and U.S. mid caps. The two weakest sectors are Latin America and emerging markets. Looking at the world market model, beginning with the U.S. in the center, all regions are above average, indicated by the white color in the squares. Japan is exceptionally strong in the green at 45. Asia less Japan is lagging. Looking at the Asian countries, the leaders continue to be Thailand, Philippines, Indonesia, China. Australia, Hong Kong, South Korea, India, and Vietnam beginning to lag. All of the rest of the Western Hemisphere is lagging, with Latin American emerging markets below average in all 3 countries of interest. All of Europe is above average in the white, with the exception of Austria. Looking at the U.S. versus global business sectors, the U.S. continues to lead or tie in all categories, with now strength being found in U.S. Financials, and the defensive plays from last week of staples, utilities, and healthcare have moved out of the green into the white. This could represent a shift in the risk-on trade away from the defensive sectors and more towards the risk-on assets like mid-caps, small caps, and then finance and energy. So we'll be prepared to protect our profits in XLV and XLP, and then in the pharmaceuticals. In the alternate asset classes, gold, silver, and commodities continue to get crushed in the red. Oil, treasuries, and corporate bonds are lagging, with U.S. real estate and private equity index above average. Looking at the top 30 ETFs out of the ETF2 database, the leaders continue to lead, with Japan, biotech, clean energy, U.S. retail, pharmaceuticals among the top performers. We're very interested in those that are color-coded green in the strength column and white in the consistency column. The strength is the current blended relative strength of the last 3 and 6 months. The consistency column is the 10-week moving average of that strength column. So what we want to see are those that are green in strength but white in consistency, just like the solar and clean energy, because those are symbols that have become new leaders and are pulling away from their own 10-week moving average. Conversely, in the middle of the table down there, you see Philippines, which is white on strength but green on consistency. This is a former leader that is beginning to lag and leaving the leadership position. So we're looking for those that are green in strength and white in consistency. Other than that, no major changes among the leaders. This is the Dow 30, looking with the same lens and scored against those 1,500 ETFs in the ETF2 database. Hewlett-Packard has moved back to the top of the strength column, with Boeing, Microsoft, Disney, and Verizon rounding out the top 5. Of special interest to us is Microsoft, which is green on strength but white on consistency. And you'll recall that a month ago, Microsoft was in the bottom 10% of the Dow and has now moved its way all the way to the top, and we've been enjoying that move in Microsoft for the last 3 weeks. Also moving into new leadership positions are DuPont, Cisco, and Bank of America. And Johnson & Johnson is beginning to lag a little bit. The bottom feeders remain Alcoa and Caterpillar and ExxonMobil. It's important to notice that there are no coded red in the strength column, and that means even the weakest member of the Dow is among the stronger candidates when considering the world market model, and that reflects the strength in the U.S. and the U.S. large cap sectors. Just a quick look at the ETF liquidity report, and these are the top 30 ETFs based on average daily dollar volume traded for the last 30 days. The S&P has an ATR percentage of 0.8. IWM, the Russell 2000, is about 1.5 times as volatile with an ATR percentage of 1.17. The VIX has declined in volatility down to 2.90%, and gold miners at almost 4% ATR percentage. So the ones that are color-coded green are exceptionally good intraday candidates because they are both liquid and volatile on a daily basis. We're going to shift now to the daily report. I'm not going to reread the top row because that was already in the weekend report. We'll take a look at the gap statistic right now. And looking at the last 30 days for the S&P, you'll notice that 17 times out of the last 30 days that the market has gapped up, 18 times in the last 30 days the market has gapped up. 17 out of the 18 days that the market has gapped up, it has continued to close higher with an average follow-through of 0.43%. Only one time in the last 18 days that the market has gapped up has it then reversed to close lower intraday, and when it did, it was sold off minus 0.79%. That's a significant trend. So if we see a gap up on Monday, the pattern is to be prepared for it to continue to follow through for another 0.5%. For the 12 times that the market has gapped down in the last 30 trading days, exactly 6 times it has closed lower for an average follow-through of minus 0.63. 6 times it is reversed to close higher for an average follow-through of 0.36. There's no particular pattern on gap down days. So we'll be watching for evidence of a sharp gap up. The size of the average gap in the S&P right now is at 0.40%. So any gap larger than 0.40 will be considered a large gap day, and it leads us to believe it could be a large follow-through day. You can see the time series of the 10-day NDX. We've been overbought for a long period of time and continue to be overbought for a long period of time. There is a overreaction signal in EPP, Asia less Japan, and a channeling signal in EPP, Asia less Japan. Looking at the 10-day max pain, the 5 symbols in the Dow that have lost the most: Caterpillar, Alcoa, Merck, Walmart, and Pfizer. The ETF losers have been gold miners, the double VIX, silver, and gold. We have channeling signals in Asia less Japan and Brazil, overreaction signal in Asia less Japan, triple screen in utilities, 551W in emerging markets, and then also in Alcoa and Caterpillar. And then in the auto framer, these are the symbols that test out better than 2 to 1 based on trade location, using the 10-day high as the price target, and then a mechanical entry and a mechanical stop based on yesterday's range. And those symbols are Asia less Japan, Latin America, silver, Caterpillar, treasuries, coal, and emerging markets. So plenty of targets to choose from. Looking at the Dow tactical summary, only one symbol, Caterpillar, tests out better than 2 to 1 on the auto framer, and that comes in at 3.2. That's an interesting one because it's number 4 on the max pain range compression and is a 551W candidate, and is recovering from being a big loser over the last 3, 6, and 12 months. We have no symbols that are single digit on RSI2. We have a large number of frog candidates that test out better than 3 to 1 for intraday trading. The big percent losers on Friday: Walmart, Merck, Pfizer, Travelers, and Hewlett-Packard. Big winners: IBM, United Tech, Microsoft, Boeing, and JP Morgan. So Microsoft ought to be of great interest to us. It closed at a 10-day NDX of 135, meaning that the breakout on Friday was 35% of the last 10-day trading range. So that is a considerably strong breakout, and it broke out to a new 10-day, 1-month, 3-month, and 6-month high, indicated by the color-coded green. on the right-hand side of the chart. So all of those that are in green are ones that had closed at new 10-day highs, and that looks to be very interesting if we want to play second-day momentum. In the ETF 30 tactical summary, we have a half a dozen symbols that test out on the auto framer at better than 2 to 1. Gold and silver are at the top of the list in max pain range compression. Gold is a 5-day down. You can see on the price change that it's been crushed relative to the other ETFs over every time frame from 1 day to 12 months, and it broke down to a new 10-day and 1-month low based on Friday's week close. It has an RSI2 value of 0, meaning it's a 2-day washout, and so therefore becomes an easy trade to frame for a 1-day rebound using day 1 techniques. Other interesting targets are treasuries and the VIX. And then on the long side, XIV broke out to a new, almost broke out to a new high. It was a % winner on Friday, and if it gets above 24, it could really go. Energy was the other strong sector that broke out to new highs on 10 days, 1, 3, and 6 months. Looking at additional market mosaic indicators, you can see the regression line of the last 30 days in the upper left-hand corner, breaking out to a new high. You can see the time series of the slope of that regression line compared to its 10-day moving average below. And so what we have is the slope of the regression line better than its 10-day average, and it's more than 1 standard deviation away from the 6-month average, so that is the sign of a raging bull. Upper right-hand corner, you can see the 180-day time series, and it is moving to a 6-month high in terms of quality of slope, and so this gives the potential for one more leg up of 5 to 8%. This is also a natural place for it to stall and to revert to the mean. So we want to respect potential breakouts, but also respect our profit protection stops. Looking in the lower right-hand corner, the S&P % stretch relative to the 200-day moving average at 13.5%. We're now 2 standard deviations above the 6-month average, which gets us up into nosebleed territory. And so this can either be the beginning of a raging bull for another 5 to 8% move up, or a logical place for people to start protecting their profits after an extraordinary move in the last 90 days. So adjust your stops accordingly. These are the fail stats for the Dow 30 and ETF 30 for your reference. I'll just show the chart and let you refer to that later. The signal to noise ratio. Taking a look at the z-scores of the regression line slopes of the last 180 days for the S&P, you can see that right now the 90-day regression line slope in red is above the plus or minus 1 z-score channel, so this is an extraordinarily strong 90-day trend. The 30-period regression line has moved out and has made a new 6-month high. You can see that's out of the channel as well. And the 10-period regression line has moved out of the channel above 1.0. They're all three at levels of steepness that have been turning points in the last 6 months. And so the possibility for a normal reversion to the mean trade here is likely. If that happens, price can move from 166 back down to support at 163 and 160 with no surprise. And so that's why we want to respect the profit preservation stops here. In the southern half of the chart, you can see price with respect to the river that we have made 1, 2, 3 legs up, starting a 4th, and have broken out to a new high. Normal momentum would give us another 5 to 8% here. A retracement would bring it back to the southern end of the river where it has moved 1, 2, 3, 4 times before while still keeping the bull alive. And again, that would bring it back vicinity 160 and even as low as 155. So respect your stops, but continue to play the strong trades to the upside. The rest of the charts being provided just for your reference, and I'll take questions by email and in the chat room during the week. And that concludes the executive summary of the weekend trading reports. Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.